This is the Daily Market Rundown live from the Tradelo trading floor. It's May the 5th. Some highlights from today's show. US equity indices have now found some sellers. US dollar is a very key black swan, and Bitcoin is going to benefit from a weak dollar. Good day traders, and welcome to another week of action-packed futures trading. It is Monday the 5th of May and there's a number of things going on across the board. There's actually a very key signal that we've had in the equity indices overnight, but we'll get to that in a moment. I think the first place to start is to talk a little bit about what's going on in the Taiwan dollar, not necessarily because that will have implications at a macro level, but because if we think two steps ahead of it, there's a very key signaling that's coming from that. So let's get across and talk about our first topic of today, and it's very much about, we've seen a very volatile move in the Taiwan dollar. Now you're probably scratching your head saying, well, what the hell does the Taiwan dollar have to do with anything? Well, the reality is, if you dig a little bit deeper, this comes from Bloomberg, and we look into it, there was a 5% move in the Taiwan dollar overnight, and it's being driven by and large by effectively life insurance companies within Taiwan trying to hedge some of their exposure. Now, let me take two steps back and explain that. Taiwan is a massive exporter to the United States. Think of semiconductors, okay? What they then do is, obviously, they have a massive budget surplus with, or trade surplus with the US. They then take those excess proceeds, that money, and they just reinvest it into US assets. Think treasury bonds, etc., etc. Now, what that means is, at an insurance level, they are hedged against the United States dollar. So, in a world where the US dollar always typically appreciates against the Taiwan dollar, because Taiwan typically wants to run a weak currency against the US, there's no real need for hedging from insurers. However, if you cast your mind back, right now, as of this year, we've seen the United States dollar come under significant sell-side pressure, and in particular, since the 5th of April, we had Liberation Day, and since then, the US dollar has suffered some significant sell-side action. Now, what that means is life insurers are effectively losing a lot of yield as a result of not being sufficiently hedged in terms of the assets they own in the United States, and that's the key takeaway. It's the situation where, if we were to see the dollar sell off more aggressively over the course of the next day, weeks, months, ultimately that's going to force even more hedging to take place. Okay, it's very much a case of, when the United States dollar is stable, when it's moving inside a range, there's not much need to hedge the exposure, because ultimately you don't want to pay away a lot of your yield in terms of hedging. Okay, that's not the case this year. And if you cast your minds back to last year, this was a similar concern we had with regards to the carry trade. Okay, it's a very similar idea to the carry trade, which was ultimately involving Japan. But the result is, when we have significant volatility in the currency, that tends to create significant problems for big pension funds in these countries that typically invest in US assets. Okay, now that's the key takeaway. And I think what I want to point out, two little things I want to point out, is obviously the central bank has come out this morning. Taiwan central bank has come out to say, look, they are looking very closely into this. They do want to obviously be very cautious with this, because they are very dependent on exports to the United States. But one of the key things that I think matters quite a lot is this idea here, where this silence from policymakers fanning speculation that there may be a broader policy recalibration. In other words, as part of the ongoing trade discussions with the United States, perhaps the United States is saying, you have to start allowing your currency to float a little bit more aggressively. You cannot run a significantly weak currency against the United States dollar. Okay. In other words, if you think two steps ahead of that, what this is leaning into is this idea that the US is going to demand, as part of the trade talks with every country, that every country needs to allow their currencies to appreciate a little bit more. Okay. Now, again, why does this matter? Well, we know what Trump's objectives are, and I'm going to keep repeating this for the next couple of months. He wants a weak dollar, he wants lower interest rates, he wants fairer trade. Now, if he wants a weaker dollar, and he's going to make that as part of ultimately the trade policy, you've got to be very careful owning US assets now, because when you try and repatriate those assets or some of that yield, you're going to pay away a lot of that in terms of, or you're going to have a lot of losses incurred owning dollar assets in essence. Okay, and I think that's the key takeaway here. It's not so much that dollar depreciation over the long run is a problem. It's the rate at which the dollar is appreciating that's creating the problem. Okay, because you cannot hedge in this environment because the cost of hedging is extremely high. Okay, think about it this way: if it costs me 3% to go and hedge my portfolio of billions of dollars of US Treasuries right now, and I'm only earning 4% or even lower than that because most of the bonds were bought in previous years, so call it 3%. Effectively, it's going to cost me as much to hedge than I am going to receive in terms of yield. Okay, and that's the problem in the current environment. It's too expensive to do a lot of that hedging. And that's why I've sort of said the key canary in the coal mine, the key black swan now, I think, is actually, it's not so much yields. Okay, I think everyone's looking at this back to front. They're saying, well, look, if 10-year yields get above 5%, that's going to break things. Yes, I agree with that. But I think the thing that gets US 10-year yields to 5% is ultimately the weaker dollar. Okay, the weaker dollar is the signaling from the rest of the world that they are exiting the United States, that they don't want to hold United States assets and they rather want to shift those investments. Okay, and I think that's the key, and that's why I've got this monthly chart up. What you can see is at the start of the year, there was no problem. Okay, if you look at the dollar index, you can see that very rarely does the dollar actually move. When it does move, what does it do? It's typically appreciating. So if I'm owning US assets, there's no need for me to hedge because it's either appreciating or not going anywhere. Okay, and this is what it's been, like since before I started even trading. It's always been relative stability in the United States dollar. All of a sudden, what's happened in the last 2 months? Okay, we've had significant depreciation. We've had a 12% drop in the Dixie this year, and we're only in May at the moment. Okay, moreover, should we get a continuation of this volatility, should you see the dollar start to sell off over the course of the next couple of days and weeks, months, that's going to spill over into a lot of other problems, which is a lot of these hedge funds, a lot of the pension funds are going to have to very aggressively hedge. And what does that mean? It means they further sell dollars, they further sell treasuries to repatriate those funds, okay, because it's too expensive to hedge at this point. And that's the key here. The canary in the coal mine is very much what goes on in the United States dollar. Now, for interest sake, and this is the key to stress here, this is zooming into the US dollar, okay? Because what you can see in terms of the index is that's Liberation Day. Now, if you look at any market, the S&P is right back to where we were Liberation Day. US bonds almost back to where we were. Well, they've traded back to the Liberation Day levels. The United States dollar, however, is still 3.25% lower. Moreover, and this is key, this purple line here is ultimately rate cut expectations. You can see, obviously, rate cuts got ramped up, the dollar weakened. What happened? We then reversed pretty much that entire move, okay? The entire Liberation Day move, we're back to unchanged here, yet the dollar's still 3.25% down, right? I want to stress the United States dollar is the one that's going to break everything up, and you've got to keep a very close eye on it. For now, we are very much in this range between 100 and 98, but don't be surprised if this snaps at some point lower to the downside, then we are going to see some significant weakness filter through across all the markets. Okay, now, let's go ahead and also just pay attention to the Japanese yen, because we know obviously that Taiwan is a massive owner of US assets, and the reason I mention is we have got two key auctions this week. We've got 10-year auction out of the US again and a 30-year auction on Thursday, and they're going to be very closely watched. Now yes, the last two auctions super strong. Okay, one went through the issued level and it was very, very strong. Both auctions were taken up very, very well. Is that going to be the case this month? Perhaps. Perhaps not. Okay, watch them closely. That first week auction is going to create not just panic sell-off in the bonds, but panic sell-off in the equities, panic sell-off in the dollar, etc., etc. You get the gist of it. Now, one of the key levels to pay attention to this yen is the 140 level. Okay, again, not just because it's support. Yes, we can see it's acting as support, but because we're already 12% up. 12%. I cannot stress 12% in Japanese yen against the dollar is a significant move historically. It's not a small move. Should we take out that 140, don't be surprised to see a significant sell-off. Why? Not because of the level, but because, remember what I said to you, pension funds have got to hedge that exposure. Now, if they're not going to hedge the exposure because it's too expensive, they are going to repatriate. In other words, they're going to liquidate the asset and bring the flows back on shore. Okay, they'd rather invest in their own bonds or perhaps in European bonds than sit idle in US bonds where the currency keeps depreciating. And that's the key takeaway. Watch a close eye. That 140 goes and you see volatility or very strong continuation in the end. Don't be surprised to see the equities down 5, 10, 15% over the course of the month of May. Okay, very important to keep an eye on that Japanese yen. Okay, our next topic, Trump says he wants a fair trade deal with China. So it's a little bit of an update here. What has he said about China? Well, again, there's nothing new necessarily from this. I think two key takeaways is he wants a fair trade deal from China. And then, of course, we know the Chinese stance, which is we want you to respect us. We want you to remove all those retaliatory tariffs. I think the key takeaway from this is asked if there would be any trade agreements announced this week. Trump said there could very well be. Okay, I think this is a very, very important one to watch this week. Is that first deal is going to set the tone for everyone's deals, and it's going to be important to see who that deal comes from. Now, there is some speculation it's either going to be India or perhaps even South Korea. So keep a close eye on that. Whoever that deal comes from, I suspect the market's going to jump on it. It's going to like it. There's a deal. Hey, look, they got a deal. But Trump has also gone on to say that there are some countries ultimately that he did not expect to reach a deal with. Okay, and I think that's crucially important. Who are those countries and how are you going to treat them? Okay, because remember, if we cast your minds back to 2-3 weeks ago when we started talking about this gauge, this tariff gauge, we said the lower end of the tariff gauge was 2.5% because that's where we started this year. Trump then said he wants to impose a minimum 10% against everyone, at a minimum, okay? But then we started talking about some sort of a tariff rate around 25% because of all the things that were going on with regards to retaliation in China, etc., etc. Okay, the point is we don't know where we are on this gauge, but when we start to get those first couple of deals, we're going to start to understand more or less where we sit between the 10 and 25. Okay, moreover, we also want to know ultimately what's going to happen to those countries that don't abide by the US and what are their tariffs going to be. Is it going to be retaliation? Is it going to be the European Union? We just don't know who it is. So you've got to listen very carefully as to how those get treated. And then you also have to think 3 steps ahead. For example, if it is Europe, who's a massive a trade partner of the United States, and they are going to get some sort of a punishment or retaliation, that's going to have significant implications for global growth. Okay, so it's very much about who is the country they're referring to and what is the treatment of that country. Okay, in the same way, when these deals come through this week, who is the country, how big is their trade relative and with the US, and ultimately what is that tariff, that marginal tariff that's actually been applied. Okay, because the market's going to take that number and it's going to try and model it, and the markets are then going to move based on that. Okay, so very, very important. Keep a close eye on that this week. I suspect we do get some news. Now, very important again over the weekend, Trump was asked about Powell. And I think people are missing something crucially important here, and I put out a tweet about this. Yes, Trump has said he won't fire Powell, but that's not the news. The news is the fact that he's then gone on to say, look, I'm not going to remove him, but why would I remove him? Because guess what? I'm in charge, and in a short period of time, I get to choose the Fed chair. Now think about that logic for a second. If he gets to pick the Fed chair, who's he going to pick? He's not going to pick someone that doesn't listen to him. He's going to pick someone that'll do as he says. So this idea that it's okay, he's not going to fire Powell, the Fed's independence is okay, that's absolute rubbish. Okay, the reality is he's going to choose someone that he can use as a pawn to do what he needs him to do. Right? There is absolutely no independence at the Fed for the next 4 years, and so as a result, to own US bonds or to own any US assets at this point in time is absolutely ludicrous. It makes no sense. This idea that he won't fire Powell is good news for the market is rubbish. Okay, the fact that he is so adamant about the Fed and the attacking of the Fed means the Fed has no longer got the independence it needs. Sure, we've got Powell out later this week, and we will, of course, watch that Fed meeting very closely. But one thing I want to stress, should Powell buckle, and this is very, very important to stress, should for whatever reason Powell come out dovish this week, for whatever reason, particularly after these 2 strong data points we had at the end of last week, should Powell come out dovish this Wednesday, yes, the market's going to initially like it, but the very next thing the market's going to do is go, oh shit, why on earth has he suddenly caved in to all the political pressure? Okay, the Fed independence is gone. It doesn't matter how you want to read into it. The Fed independence is gone. Long term, you do not want to be investing in long term into US assets. And that's why I've got this chart up here of US yields. The idea that you want to own US 10-year at 431 or at least own duration today makes no sense. What do I mean by that? In an environment where we have now got inflation that is going to be ticking up. You look at swaps markets, they're talking about a much, much higher inflation towards the end of the year. Okay, they're talking about CPI prints and PCE prints getting back above 3%. Okay, the point is in this current environment where we don't know the implications of tariffs and what it's going to do to markets, ultimately buying 10-year bonds today at 431 doesn't make any sense. Why? Well, because you can probably buy the exact same bond 1 year from now when things settle down at 431. Okay, in other words, the risk reward is skewed towards higher yields, not lower yields. And that's also, if you go look at the 200-day moving average of 10-year yields, they are absolutely bang flat for the last 2 years around the 430 mark. In other words, yields have not gone lower over the course of the last year. They've been stuck around this 431 level, and currently with the fundamentals we're seeing, the risk reward is skewed towards higher yields, not lower yields. Okay, and so if you factor in both what we're seeing at a Fed independence level as well as technical level, it makes no sense to own duration right now. If anything, you don't want to be necessarily shorting bonds, but you definitely don't want to be long of bonds, and particularly not long bonds. Okay, and that's why I suspect perhaps this week, perhaps next month, at some point we're going to get a weak auction. At some point the market's going to smell it out. You were going to see a weak auction and you're going to see a panic move off of that. Okay, keep a very close eye. That move and that opportunity scope is incoming. All right, now turning our attention to the S&P 500, there was a very key clue on Thursday last week. We finally saw some selling coming in on Thursday. Okay, it's that little, call it doji candle there. It was met with a relatively positive day on Friday. Why? Well, because the non-farms came bang in line. Okay, and just for context, bang in line was good for the market at a brief sort of moment. It was just, okay, it wasn't so bad, so we'll bid it up. As of this morning, two things are very important. One, you need to note that selling stepped in on Thursday. Those sellers have been found. That is the key. Sellers entered the S&P 500. It doesn't matter how you want to cut it. They sold the market on Thursday. Of course, the market then bid up on very low volume on Friday in the non-farms. But again, in the overnight session, we have seen those sellers emerge. We have got a little gap down. And ultimately, this is the second time now around this 5,700 we are seeing those sellers. Okay. The key to any turning points is not necessarily picking them or trying to time them. It's just using objective information to understand where are those sellers entering. Okay, we have seen sellers twice now around that 5,700. What that means is not necessarily that 5,700 is the level. What it does mean now is the risk reward for example, a 10% move to the downside is very much, or at least the risk reward is skewed very much towards a down move rather than an up move. In other words, if I had a 5% stop versus a 10% target, I think the odds of you hitting the 10% downside target are significantly higher than hitting the 5% stop. Okay, and that's just because we are now seeing those longer term sellers re-enter the market. With that in mind, I think keep a very close eye. There's a lot of similarity between what we're seeing now in 2022. I want to stress it here. This day, of course, we had a little gap lower, very similar to what we've had overnight. So we had that gap lower, we had that follow through, market consolidated, squeezed out those sellers one last time, had the outside candle and rolled back down. Okay, now there's a big difference between, of course, what we're seeing, in 2025 versus 22. But I just want to stress that there's a lot of similarity. We've had, of course, that gap down day today. I expect we're going to follow through to the downside, perhaps come tag that little gap fill, maybe have one last little bit up at some point, but then I expect we are going to roll back down towards that 4,800 level. Okay, keep a very close eye. I think the technicals, and in particular, I think those sellers emerging on Thursday is a very, very key signaling clue. And then finally, in the comment section, I did have someone asking about Bitcoin. I think Bitcoin's interesting. Okay, for the first time, I'm not turning bullish Bitcoin, but I think there's a case for Bitcoin to be had over the course of the next couple of weeks. And that case is not so much owning Bitcoin outright, but I think we're about to see a breakdown in the correlation between Bitcoin and the Nasdaq. Okay, what you can see on screen in red is Nasdaq. Okay, and what you can see in the orange is Bitcoin. It's a monthly chart, and for a very good reason. You can see a direct positive correlation. They are almost an identical chart. Okay, that's the key takeaway. If you think Bitcoin is anything other than a risk market, you perhaps need to just stick this chart up in front of you. However, here's the caveat. What Bitcoin is also, yes, it is very much a risk market, but it also is a currency. Okay, so there will come a point at which I think we'll see again the Nasdaq move lower, and I think Bitcoin will again move lower. But there is going to come a point where Bitcoin's going to start to trade a lot more like a currency. In other words, should we see significant sustained dollar sell-off, I think you will start to see Bitcoin be a very strong benefactor of that. Okay, and the reason I say this is because 2 or 3 times over my career trading Bitcoin, there have been instances where we have seen sustained dollar weakness, but not the kind of sustained dollar weakness we've seen now. Okay, never in my career have I seen a dollar move that we are seeing currently and the speed at which we're currently seeing it. And so that's why I think this time is a little bit different. Now, what you've got here is perhaps a little bit messy, but just follow along. Again, in the red, you've got Nasdaq. Again, in orange, you've got Bitcoin. But what I want to cast your mind to is the bottom two here, which is in yellow, you've got the dollar, and in blue, you've got Ethereum. Okay, now what I want to showcase to you is notice what's happened since Liberation Day with Ethereum. Okay, it sold off from whatever 3,400 all the way down to 1,800, and it's had a very shallow bounce. What has Bitcoin done? it's retraced the entire Liberation Day. Why? Well, because what happened at that same time? We saw dollar sell off significantly. Okay, and this is the key takeaway, is that Bitcoin is now going to outperform all other crypto coins, in particular Ethereum, simply because of the implications of a weaker dollar. Okay, moreover, we can see how, obviously, if we go and just remove this, okay, if you look at obviously what Nasdaq's done, okay, Nasdaq has bounced. It's erased the entire Liberation Day move. You can see we're back to there. But at the same time, where's Bitcoin? Bitcoin's even slightly higher than the Liberation Day. Okay, if you were to go draw some sort of a Fibonacci, you'll see Bitcoin's almost leading the Nasdaq. In other words, it's somewhat outperforming the move versus Nasdaq. Okay, now again, it's early days, but keep a very close eye on that dollar. Okay, if we do see that dollar start to sell off, the first sort of implication for Bitcoin is a sell-off. Okay, Bitcoin's not going to hold up. People aren't going to sit there buying Bitcoin just because of what's going on in the dollar. This is going to be one of those plays where I suspect the Nasdaq will continue lower and Bitcoin will start to outperform. In other words, if the Nasdaq is down a significant amount, Bitcoin will still be down, but to a lesser degree. Okay, keep a very close eye. I think it's a very interesting fundamental, and like I said, if you go look back in terms of history, we've never had the kind of move we've had in dollar that we're seeing right now. Okay, so at some point, I think this will become a theme. It'll be a story. People will start to point and say, hey, look how well Bitcoin's performing as a hedge against continued dollar weakness. All right, that's then, of course, a wrap. We do have today the all-important manufacturing data, the ISM services data. Keep a very close eye on that. I think that's going to be very, very closely watched. We did have the strong manufacturing data out late last week, which gave the market quite a bit of support. I think the key takeaways from that was the number was somewhat better. The result was, of course, we did see long bonds sell off on this idea that perhaps the Fed won't need to cut, and should they cut, we are going to see that steepen the curve quite aggressively. So that seems to be the play here, which is good data is bad for long bonds, and of course bad data is not necessarily good for long bonds either, which again points to this theme of why on earth would you want to hold long bonds or hold duration right now. Okay, there's a lot of risk around holding duration. We'll talk a lot about that over the course of the coming market rundowns. If there are any other questions, do post them in the Discord channel. If you would like me to discuss a certain chart or a certain market, look, if I trade it, fine, I'll discuss it. If I don't trade it, I'll tell you I don't trade it. So do post them in the comment section. Happy to discuss them. Otherwise, good luck out there. Manage the risks. Go make some money.